you're building a deep tech company right now, the fastest path to €1 billion exit isn't always building harder. It's building proof first. And I'm going to show you exactly what that looked like in a company just 16 months old that got acquired by SAP for over €1 billion. I'm Maria, and I've assessed over 7,000 startups. I've also invested in 70 plus companies. When I read the Prior Labs SAP announcement this week, I didn't see a one-off deal. I began to see a pattern. 16 months from incorporation, one round, €9 million of pre-seed funding, 3 founders. SAP acquires them and commits more than €1 billion over the next 4 years to scale as an independent frontier AI lab. I'm not going to talk about the deal today. I'm going to pull out 3 structural lessons every founder watching needs to internalize. Because this is a playbook. And for you, next 16 months, an exit could be yours. Or even if you're not optimizing for an exit, at least a much more valuable company strategically than you have now. Lesson 1. Your cap table is your distribution strategy. The investors who write your earliest checks will often determine who acquires you, or who at least does a follow-on round. Watch how this plays out, especially in Prior Labs. Their pre-seed round included the Hector Foundation. Who is the Hector Foundation, you might ask? Great question. Hans-Werner Hector co-founded SAP back in 1972. So the Hector Foundation was founded by the co-founder of SAP. That's already a tell, and it's very easy to spot. But here's a deeper one. Hector also funded the Ellis Institute. Now, the Ellis Institute, he funded $100 million over 10 years, and this was announced in 2022. Prior Labs spun out of Ellis. Now, Bernard, one of the founding directors of Ellis, is a Prior Labs advisor. And Frank Hutler, Prior Labs' CEO, holds a Hector Fellowship. Do you see the pattern? The entire research that produced this company was SAP adjacent 3 years before the incorporation, not on the day it was announced, not 6 months before, 3 years. The exit wasn't engineered in 2026. The conditions for this were laid as early as 2022. Now, I see this in my own investments and in the founders that we back. Those who tend to have follow-on fundings, cleanest exits, are often the ones that optimize not for valuation, but for actually who is on their cap table. They're usually quite strategic. In fact, we had a recent episode on this. He had $100 million exit and was very smart about who he put around his table as advisors, as investors. Here's the founder takeaway. Every angel, every fund, every foundation, every single person on your cap table is a quiet voice about who you're building towards. Pick carefully. Number 2, and this one is going to feel counterintuitive. If you've been told that open source is just a marketing tactic, it's not really. It's positioning, and you can be very strategic about it. Prior Labs published their core model, SAP PFN, in Nature in 2025, January. Now, they open sourced it as well on GitHub. 6,000 stars. That's 6,000 people publicly acknowledging that it is good. Now, in November 2025, SAP launches its own tabular foundation model, SAP RPT-1. And they did this in Berlin. And here's the part that most people miss. SAP's RPT-1 was built on SAP PFN's infrastructure. It was built on Prior Labs infrastructure. They didn't compete with Prior Labs. SAP built on top of them. 6 months later, they bought the team that wrote the original. Now, there's a takeaway for founders. When your code is sitting inside an incumbent stack, you're not a vendor anymore, at least not just a vendor. You are the cheapest path to their next version. Open source isn't just free distribution. It can be strategic. It's positioning yourself directly into an enterprise supply chain. And Prior Labs did this beautifully with SAP. So the question that every deep tech founder needs to answer this year is, whose stack do you want your IP in by the end of next year? That's the question to ask yourself. Now, lesson 3. It's probably counterintuitive. It might be against the founder advice that you've heard recently. In fact, maybe some that you've heard on this show. But the advice is, build credibility before you build the company. Frank Hutter and Noah Holman, the founders of Pure Labs, published the original SAP PFN paper in 2022. They presented it as an oral in a conference, ICLR, in 2023. Nature publication in 2025. Look at the timeline. And then in January 2025, they incorporated. And by that time, the IP had been there for 3 years. It's been validated by the academic community. So when they raised their 9 million pre-seed round, they weren't raising from zero. They were raising scaling capital. The science was already done. The market knew it worked. There was public validation. The acquirers knew it worked because they'd used it themselves. Now, most founders tend to try to build their credibility inside their new startups. They do this through product launches. They do this through customer logos, the metrics, etc. That's the fair path. But Prior Labs built credibility before the company existed, 3 years before. Now, I know some of you might be saying, I don't have a nature paper. I'm not a research professor. This doesn't really apply to me. But here's the thing. The principle remains the same. The principle applies to you. And I will push back on that notion that it doesn't apply to you because this principle scales. Every founder can ship one credibility artifact, something before they incorporate a real working prototype with real users, a signed paid pilot, a technical paper, waitlist that shows that there's proof of demand, something that says that I am already building in this place and it works before you ask anyone to fund the next stage. It's usually quite nice when you're pitching and your pitch is essentially, I know it works, that's not the problem. I'm trying to sell this and I need money too. That shape is essentially the same. Proof first, company second. Now, stack these 3 lessons together and you will begin to see a pattern. The reason SAP could justify €1 billion, not a million, not 100 million euros, €1 billion commitment in a 16-month-old company is that it wasn't a 16-month-old company. Prior Labs had spent the previous 3 years de-risking every layer of this business that usually breaks during an acquisition. The science was de-risked through nature, the strategic fit was de-risked through the cap table, the integration risk was de-risked through open source. So they had been very strategic about building this long before they started publicly building it through their company. This is the new template of European deep tech. I'm seeing this across Mistral, Black Forest Labs, and now Prior Labs, different categories, but similar. The exit isn't built in the last year. It's engineered from day zero. So if you're a founder watching this and you're hearing my voice right now, here are 3 questions to sit with and answer honestly this week. The first one, whose stack is your IP positioned inside? 2, whose orbit is your cap table signaling? What story is your cap table telling? 3, what proof do you have that shows that you have shipped outside your pitch deck? Put them together and that 16-month exit could look very feasible. And even if you don't want to exit in 16 months, then you're building something incredible. Now, if you're building in this space and you want to talk it through, 2 founders every month get a call with me as an early stage investor. Put your name and your details in the link in the show notes and the comments. What did you think about this episode? Is there anything interesting from the deal that you spotted that I didn't mention? Share your thoughts in the comment below and see you on the next episode.
Tell us what you think of this episode on all of our platforms at the Startup Leap Pod. Do you have a question? Ask us and we'll ask our guests. Go to thestartupleap.io. See you next time.